Okay, let's unpack this. We are diving deep into the real strategic meat of the recent Enphase energy update. We're focusing just on the Q&A session from their Q3 2025 earnings call, like you asked, skipping the prepared stuff.
Yeah, and it's a really interesting Q&A because, well, the company's clearly walking this tightrope. On one hand, you've got this big, um, unavoidable financial hit coming, right? That Q1 2026 cliff when the U.S. tax credit
Here
expires.
at the 25D.
Exactly.
Ah,
But then, at the same time, they're launching all these, like, major long-term growth drivers.
hmm.
New finance options, global partnerships, next-gen silicon with GaN, new batteries.
It's quite the balancing act, managing this really sharp downturn that's coming while betting big on the future.
It really is. It's a
Yeah.
study in managing, extreme short-term pain while keeping your eyes firmly on innovation.
So that's exactly what we need to break down for you. We'll look at how they're almost engineering this difficult Q1, what's really going on with gross margins and tariffs. And then we pivot to the, frankly, more exciting stuff, the ways they plan to work around that lost tax credit. Plus, the details on the IQ9 GaN microinverter and this completely redesigned 5th-gen battery they keep talking about.
Yeah, it's volatility meets innovation. So where do we start? The immediate financials, I guess? Q4 guidance?
Let's do it, because the Q4 numbers, they look a little weird at first glance. They're saying installer sell-through, actual sales to homeowners. That should be pretty strong, like $350 to $400 million.
Right, because everyone's rushing to install before that tax credit disappears at the end of the year. Makes sense.
But then Enphase's own revenue guidance for Q4 is much lower. It's $310 million to $350 million. That's a pretty big gap. Why guide lower when demand seems high?
Yeah, it looks odd, but it's actually quite strategic when you dig into it. First off, remember they pulled about, what was it, $70.9 million of safe harbor revenue into Q3?
Ah, right. Revenue they booked earlier but was really for Q4 shipments.
Exactly. So Q3 looked better, but it automatically lowers the Q4 starting point. That's part one. Part two, and this is the key strategic move, is they're aggressively destocking the channel.
Destocking, meaning they're deliberately shipping less product than installers are selling.
Precisely. They said they're intentionally undershipping by about $45 million.
Yeah.
Right in the middle of their guidance range. Why? Because they want, and they use this phrase, a very healthy setup in the channel going into 2026.
Which means what in practice? Less inventory sitting around.
Yeah, the target is 8 to 10 weeks of inventory. By undershipping now, even with good demand, they drain the excess.
Right.
So when Q1 hits and things eventually recover later in 26, that recovery isn't, masked by installers just selling off old stock.
They want a clean slate. Got it. Makes sense. And that sort of cautious tidying up approach, it extends right into their early look at Q1 2026, doesn't it?
Oh, absolutely. They are really trying to set expectations low for Q1, prepare the market.
What are they saying?
They're calling Q1 the cycle trough, estimating company revenue around $250 million, which is, a big drop, larger than just normal seasonality.
And that's purely because of the 25D tax credit expire.
That's the main driver, yeah. They expect a huge drop-off, especially in the loan and cash markets, right after it ends. So they're setting this floor, maybe even setting it incredibly low. The idea is if interest rates happen to fall or power prices keep rising in 2026, any recovery will look really strong against that low base.
Okay, that covers the revenue picture. Let's talk margins, because Q3 looked great, almost 50% non-GAAP gross margin.
49.2%, yeah.
Very strong. But the Q4 guidance drops quite a bit, down to 42% to 45%, so a midpoint of, 43.5%? What's driving that nearly 6-point drop?
It's almost entirely down to tariffs, specifically reciprocal tariffs impacting batteries. They actually broke this down quite clearly. That high Q3 margin is because of a really unusual product mix.
More microinverters from that safe harbor stuff.
Exactly. Microinverters are their high-margin bread and butter. They even calculated that without the tariff impact, which they pegged at 4.9%. Q3 margin would have been 54%.
Wow. Okay, so that shows the underlying health of the core business.
It really does.
Yeah.
So that Q4 guidance, the 43.5%, that reflects what they called a more normal product mix, meaning more batteries, and batteries are getting hit by those tariffs. If you add back that roughly 5% tariff impact to the Q4 guidance.
You get back to around 48.5%.
Right. So the underlying profitability, excluding tariffs, is still very strong. They're not like suddenly losing pricing power.
And they're choosing not to just hike prices to offset the tariff?
Seems not. They mentioned holding pricing, especially on newer things like the 4th-gen battery. Sounds like they want to gain share and support installers through this rough patch, even if it means taking a short-term margin hit.
Okay, but long term, Those tariffs, especially on battery cells from China, that's a big headwind, 40% plus tariffs.
Huge. Yeah, it's a structural issue for battery margins right now.
So what's the plan to fix that? How do they recover those margins permanently?
It's basically a two-pronged strategy, and pretty smart, I think. First, supply chain diversification. They're pushing hard to move away from China-sourced cell packs, expecting to ramp up non-China cell pack supply in the first half of 2026. That tackles the tariff issue head-on.
Okay, makes sense. Geopolitical hedge too. What's prong two?
Innovation. That's the fifth-generation battery. Its whole architecture is designed specifically to bring the system cost down significantly, so they're using R&D as the antidote to tariffs.
Interesting. Okay, so since that Q1 trough is so tied to the 25D tax credit cliff, let's look at how they plan to fill that gap, especially since everyone expects the market to shift hard towards third-party ownership, TPO, in 2026.
Right. And Enphase is signaling they're ready to support TPOs with the whole safe harbor planning process.
Yeah.
There was maybe some concern they'd only back one method, the traditional 5% fair market value one.
But they confirm they support both.
Yep. They explicitly said they're ready for the second option, too, the physical work test method.
And the physical work test. Remind us why that's a big deal for TPO partners. You called it an aha moment.
It's potentially a huge deal for their cash flow. Basically, instead of committing, 5% of the total future project value up front, which can be a lot of cash tied up for years, the physical work test lets them qualify by buying a much smaller custom component, like a special controller board.
Just buying that small part legally counts as starting construction.
That's the idea. It establishes the start of construction for tax purposes. The key benefit, it could reduce the TPO's upfront cash outlay by maybe like 10 times compared to the 5% FMV method.
Wow. Okay. That makes planning for installations years out, like 2028 to 2030, much, much easier.
Way easier. And for Enphase, it's actually better, too.
How so?
Well, instead of one big lump sum payment years down the line, they get revenue for that small component now. And then they get the main microinverter revenue later when the actual install happens. It smooths things out. Win-win.
Clever. Okay, that helps the TPO market. But what about the regular loan and cash buyers? That market's expected to crater without 25D.
Right, and that's where their other big financial innovation comes in.
Yeah.
The prepaid lease, or PPL, paired with a loan.
Okay, I've heard about this, but it sounds complicated. A lease and a loan. How does that help the average homeowner?
It does sound complex, but the argument is all about the final economics. Here's the breakdown. Legally, the TPO company owns the system initially. That allows them to capture the commercial 30% tax credit, the 48E credit.
Okay, so the TPO gets the tax break, not the homeowner directly.
Correct. Then they structure the deal as a prepaid lease for the first 5 years. At the end of those 5 years, the homeowner typically has the option to take ownership.
So the TPO uses their tax benefit to lower the cost of that prepaid lease.
Exactly. They pass the savings through. The net result, according to Enphase, is that the homeowner's total cost, the PPL payment plus their loan payment, ends up being similar to what they'd pay today with a standard solar loan plus the 30% 25D tax credit.
Huh. So it's basically a financial workaround to replicate the 30% discount homeowners are used to.
That's pretty much it. It's the industry trying to mathematically bridge that 25D cliff. Enphase's role is to make this easier with their SolarGraph software, providing O&M, helping partners find tax equity, supporting the whole structure.
Okay, this is where things get really interesting, I think. Moving from finance to the actual tech, let's talk products. We know the current 4th-gen battery, the 10C, is doing okay. But this 5th-generation battery, that sounds like the real leap.
It really does sound like a fundamental shift. They're focusing on cost reduction and, frankly, aesthetics and usability, key spec. They're moving to a 100 ampere-hour cell. Now, that might sound technical.
Translate that for us. What does 100 amp hour mean for me?
It means about 50% higher energy density compared to the current 4th-gen battery. So you get significantly more energy storage in a smaller, lighter package.
Ah, smaller footprint on the wall. Easier installation.
Right. They described it as compact, elegant, and stackable. You can stack them up to 20 kilowatt hours, and apparently it looks like one single unit. Good for aesthetics, maybe easier permits, but the real cost savings they highlighted comes from the internal architecture.
What did they change?
They've collapsed the power electronics, basically the brains and the power conversion, onto a single board.
Instead of multiple boards.
Yeah. Fewer components, simpler manufacturing, presumably lower cost, and it radically improves serviceability. This is interesting.
How so?
Apparently, with current batteries, if you need to swap a component like the internal microinverter or the battery management system,
Yeah.
you often have to take the whole heavy unit off the wall.
Which is a pain, I imagine, labor cost.
Big pain. With the 5th gen, they said you can swap those key components without removing the unit. Just open it up. That could drastically cut service costs and time.
Okay, that's a big deal for installers. And all this innovation, the power density, the potential for cost reduction, it's enabled by gallium nitride going nano, right?
GaN is the underlying platform shift, yes. It's not just for batteries. It's across their next-gen products.
Why is moving from traditional silicon to GaN so important? What does it actually do?
Fundamentally, GaN lets you switch power much, much faster than silicon, and it handles heat better. That means you can make power electronics smaller, lighter, more efficient, and more reliable, all while handling more power.
Okay, faster switching, better thermals, more power density.
Exactly. And that capability unlocks markets they couldn't address before. Perfect example. Their new IQ9N commercial microinverter. It uses GaN shipping in December, they said.
And because it uses GaN, it can handle the demands of
The 480-volt three-phase commercial solar market, a segment Enphase just couldn't play in effectively with their older silicon tech.
And how big is that new market for them?
They estimated it as a 2-gigawatt opportunity annually, which translates to roughly a $400 million total addressable market they've just unlocked.
Just by adopting GaN, that's significant.
It's not just an iteration, it's enabling expansion. That's the power of a platform shift like GaN.
And that same GaN platform underpins maybe the most potentially disruptive product they mentioned, the bidirectional EV charger.
Yeah, the BD charger. Slated for mid-2026 launch.
What's the specs on that?
11 kilowatts. Uses 3 internal GaN microinverters. But the really clever part is the positioning. They're pitching it as potentially the lowest cost and simplest way to get whole home backup power.
Simpler than solar plus batteries. How?
Because, they claim, you only need the BD charger itself and their IQ meter collar installed at your main panel. You wouldn't necessarily need rooftop solar or a dedicated home battery, at least not initially. Your EV becomes the battery for your home during an outage.
So the car powers the house directly through the charger.
That's the idea. It radically lowers the entry barrier for basic energy resilience. Very interesting play.
Okay, let's shift focus globally for a second. Europe's been a tough spot recently. Revenue was down quite a bit in Q3.
Yeah, down 38% sequentially. Markets like France and Germany were weak, high inventory.
But the Netherlands, that seems like a bright spot, or at least an interesting test case.
The Netherlands is fascinating because it shows how policy directly drives battery adoption. They're phasing out net metering at the end of 2026. Suddenly, all those homes with existing solar panels, they said 475,000 of them, have a huge incentive to add storage.
Because just exporting solar back to the grid won't be valuable anymore.
Exactly. Self-consumption becomes king. You need to store your solar energy to use it later. Enphase estimates that's a $2 billion total battery opportunity just from those existing solar homes needing retrofits.
And they're not just waiting for it to happen, they're actively stimulating demand with partnerships, like with Essent.
Right. The Essent deal is a classic VPP virtual power plant play. They're offering homeowners a fixed monthly payment up to 122 euros, depending on battery size, just for letting Essent manage their battery as part of the grid.
So you get paid just to have the battery participate.
Yeah. It makes the payback time on the battery much faster and gets customers comfortable with the idea of grid participation. Smart way to kickstart the market.
And we're seeing similar tailored approaches elsewhere. Yeah.
Australia's picking up, helped by a government rebate program starting mid-2025. And they're launching specific products like the Flex Phase battery handles Australia's common three-phase power and meets local grid operator rules. Plus the IQ8P microinverters, which handle higher wattage panels, over 480 WAC because panels keep getting bigger.
Adapting the tech to the local market needs.
Absolutely. And it connects to their broader VPP commitment. They mentioned being active in over 53 VPP programs around the world now.
Okay, let's try to pull this all together. What does it mean for you, the listener? We started with that stark Q1 picture revenue potentially dipping to $250 million. That sounds rough.
It is rough. But as we discussed, it seems like a necessary, maybe even engineered dip. The price they pay to clean up the channel inventory.
Right. Clear the decks for what comes next.
Exactly. So that painful Q1 allows them to build, hopefully, a much stronger recovery later in 26 and beyond, fueled by things like that PPL loan structure, which tries to synthetically replace the 25D credit.
And fueled by the new products, the cheaper, denser 5th-gen battery, the IQ9 unlocking commercial.
The BD charger. The strength going forward seems less reliant on stable government policy and more on having differentiated, cost-effective tech.
That raises a key strategic question, though. If incentives globally are going to be volatile, how do you build reliable growth?
Well, that's why the focus on the product pipeline is so critical. That move to GaN, the new battery architecture. It's all fundamentally about driving down the system cost per watt. At the end of the day, making solar and storage cheaper is the ultimate driver for mass adoption, regardless of unpredictable government support. Cost reduction is the best insurance policy.
And thinking about that future, one thread that kept coming up, implicitly at least, was the growing strain on the grid, potentially driven by things like AI data centers demanding more power.
Interesting angle.
So here's a final thought to chew on. That seemingly simple 11 kilowatt bidirectional EV charger we talked about, enabled by efficient GaN tech, maybe initially paired just with a meter collar, no solar needed. Could that be more revolutionary than we think?
How so?
Could your electric car, connected through that charger, become your primary defense against future electricity price spikes or grid instability fueled by massive new loads like AI? Your car isn't just transport, it's a distributed power plant. It backs up your home, maybe earns you VPP revenue. It becomes your personal off-ramp from grid volatility without the initial cost of a full solar and battery system.
Turning the car into the first step towards energy independence.
Exactly. That evolution from just making microinverters for solar panels to potentially managing home energy with the car at the center might be the biggest strategic shift underway at Enphase.